Welcome back. Over the past 18 months, millions of retirees have made a single, seemingly reasonable assumption: that Federal Reserve Chair Jerome Powell's commitment to keeping interest rates accommodative, his repeated public statements about patience and gradual rate adjustments, means rates will stay low enough to justify their current bond allocations. It feels safe. It's backed by the most powerful central banker in the world, and it's built on a dangerous misreading of what's actually happening in the market. In the next 9 minutes, I'm going to walk you through the exact contradiction between what Powell is telling investors in press conferences and congressional testimony, and what CME Fed Watch futures, the market's real money bet on Federal Reserve decisions, are actually pricing. Then, I'll show you the specific dollar impact. A household in the 55-70 age band holding $500,000 in bonds or high-yield dividend stocks earning $20.25 annually could see that income drop by $10.15 within the next 12 months if rate expectations shift even moderately. That's a 40-60% cut to income. And unless you're willing to chase yield into materially riskier assets, junk bonds, emerging market debt, or leveraged equity positions, that income loss could be permanent. Let's start with the data. The disconnect. Powell's words vs. market pricing. In December 2024, Powell told investors during his press conference that the Fed would take a patient approach to rate cuts. His exact language: "We don't see any hurry to cut rates." This is the statement that has anchored most retirement bond allocations. If the Fed isn't in a hurry, the logic goes, rates will stay elevated but stable. People bought and held bonds yielding 64%, confident that the Fed floor would protect them from further rate hikes, and that their yield would remain locked in. But here's what the CME Fed Watch tool, which tracks actual futures contracts on Fed funds rates and has a 90% plus accuracy rate, was pricing in that same week. A 75% probability of at least 225 basis point rate cuts by mid-2025. As of mid-January 2025, that probability had shifted to nearly 85% for one cut by March, with markets pricing in 75-100 basis points of total cuts by year-end. This is the opposite of no hurry. This is the market saying, Powell is already behind the curve, and investors are betting that economic data will force his hand faster than he's publicly signaling. Why the disconnect? 3 reasons. First, the Fed's own economic projections, the famous dot plot, have consistently overestimated inflation and underestimated labor market softness. In June 2024, the Fed projected 325 basis point cuts for 2024. It delivered exactly 0. In September, it projected 3 more for late 2024 and early 2025. As of January 2025, it had cut once. The Fed's forecasts have a track record of lagging market reality by 6-9 months. Second, Powell has a credibility problem with markets. After the transitory inflation call in 2021-2022, when inflation hit 9.1% before the Fed finally acknowledged it wasn't temporary, market participants now weight his forward guidance at a significant discount. They trust the futures market, where real money is at stake, more than they trust press conference language. Third, and most critically, the economic data is deteriorating faster than Powell has publicly acknowledged. The Conference Board's leading economic index fell for 8 consecutive months through October 2024. The labor force participation rate, which Powell cited as evidence of a strong labor market, has been declining since September. Unemployment, while still low at 3.9% in December 2024, rose from 3.7% in July, a trend that historically signals the beginning of a downturn. The dollar impact. Your $500K bond portfolio. Let's make this concrete. Assume you're a 62-year-old with $500,000 in a diversified bond portfolio. The portfolio is split roughly 40% among intermediate-term Treasury bonds yielding 3.8%, 35% in investment-grade corporate bonds yielding 4.7%, and 25% in high-yield dividend stocks, utilities, rate, dividend aristocrats, yielding 5.1%. Your current annual income from this portfolio, Treasuries, $200,000 times 3.8% equals $7,600. Corporate bonds, $175,000 times 4.7% equals $8,225. Dividend stocks, $125,000 times 5.1% equals $6,375. Total annual income, $22,200. Now, let's stress test this portfolio under the scenario the CME futures market is pricing 100 basis points of Fed rate cuts by end of 2025, combined with a 50 basis point decline in term premiums. The extra yield investors demand for holding longer duration bonds as growth fears increase. Under this scenario, Treasuries, when the Fed cuts rates by 100 basis points, the yield on intermediate Treasury bonds, 5-7-year duration, typically falls by 80-120 basis points depending on slope of the yield curve. Your Treasury allocation, now yielding 2.83, 52%, generates $200,000 times 2.9% equals $5,800. You've lost $1,800 in annual income, or 24%. Corporate bonds, investment grade spreads, the extra yield above Treasuries that investors demand for credit risk, typically widen during recessions or growth scares. If spreads widen by 60 basis points, not unusual during a Fed cutting cycle, and Treasury yields fall by 100 basis points. Your corporate bond yield falls to approximately 3.739%. Your income, $175,000 times 3. 8% equals $6,650. You've lost $1,575 or 19%. Asterisk asterisk dividend stocks. Asterisk asterisk this is where it gets serious. In a scenario with Fed rate cuts, equity valuations often contract because lower expected growth reduces discounted future earnings. Additionally, if dividend-paying stocks rally, companies may feel less pressure to maintain or raise dividend, and some high-yield dividend strategies, like covered call ETFs, actually cap upside. But more commonly, a 100 basis point Fed cutting cycle coincides with a 10-20% decline in equity valuations. If your $125,000 dividend stock allocation declines by 15% in principal value, you have $106,250 remaining. If dividend yields also compress from 5.1% to 4.6%, as companies become more cautious, your income drops to $106,250 times 4. 6% equals $4,887. You've lost $1,488 or 23%. Asterisk asterisk total new income, $5,800 plus $6,650 plus $4,887 equals $17,337 asterisk 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 income loss, $22,200 $17, 337 equals $4,863 or 22% asterisk asterisk. But here's the second order effect. You're now earning $4,863 less per year. If you were counting on that $22,200 to fund your lifestyle, you now have a shortfall. Many retirees respond by chasing yield, moving $50, 000, 100, 000 into junk bonds, yielding 6-7%, or emerging market debt, yielding 7-8%. That increases risk significantly. If one of those junk bond issuers defaults, or if the dollar strengthens and emerging market debt declines, you could lose 10-30% of principal. Alternatively, you could sell $100, 000 of your now depreciated bonds to make up the income gap, but you're crystallizing losses and reducing your principal base for future growth. Over a 20-30 year retirement, that compounds into a meaningful shortfall. Asterisk asterisk the hidden assumption. Duration risk in your prospectus asterisk asterisk. Open your bond mutual fund or ETF prospectus. Somewhere in the risk disclosures you'll find language like, bond prices decline when interest rates rise. Most investors read this and think, yes, I understand. If rates go up, my bond price goes down, but I'm holding to maturity, so it doesn't matter. That logic is incomplete. Here's why. If you own a bond with a 5-year duration, a measure of how sensitive a bond is to rate changes, and rates fall by 1%, your bond price rises by approximately 5%. Conversely, if rates rise by 1%, your bond price falls by 5%. Duration is asymmetric in a retirement context. Why? Because when rates fall, retirees often don't benefit from the full price appreciation. Instead, they face reinvestment risk. If you own a 4.5% bond and rates fall to 3.78%, when that bond matures or when you need to rebalance, you're reinvesting at lower yields. The capital gain on the old bond is offset by lower yields on new bonds. But when rates rise, retirees lose twice. First, the immediate price decline on their existing bonds. Second, the locked-in lower yield for the remaining life of the bond. This is the duration trap. Consider a concrete example. In 2021, a retiree bought a 7-year Treasury bond yielding 1.5%. 2 years later, in 2023, similar bonds yielded 4.5%. The retiree's bond had declined roughly 21% in price, 7-year duration times 3% rate increase. If the retiree needed to sell, they crystallized that 21% loss. If they held on, they locked in 1.5% yields for 5 more years while new bonds offered 4.5%. Over that 5-year period, they forgave approximately $150,000 in potential income on a $500,000 portfolio. Asterisk asterisk what the futures market is actually saying asterisk asterisk the CME Fed Watch tool provides daily, updated probabilities. As of mid-January 2025, here's what it was pricing. 85% probability of at least one 25 basis point rate cut by the May 2025 FOMC meeting, 50% probability of 2 cuts. By July 2025, 65% probability of 75 plus basis points in total cuts. By end of 2025, less than 10% probability of rates staying flat through end of 2025. This is not a forecast of economic collapse. It's a bet that the Fed, despite Powell's patient language, will cut because economic data forces it to. The market is saying, we believe unemployment will tick up, growth will slow, and Powell will have to cut even if he doesn't want to. Historically, when the Fed enters a cutting cycle, the first 50 basis points of cuts happen relatively quickly, and the next 50 basis points are debated. By mid-2025, markets are pricing the first 50 in. By end of 2025, the debate is whether it's 75 or 100 basis points total. Asterisk asterisk the buried assumptions in your plan. Asterisk asterisk most retirement income plans assume one of the following. 1. Asterisk asterisk rates remain stable. Asterisk asterisk your bond yields stay at 4.5% indefinitely. 2. Asterisk asterisk rates rise gradually. Asterisk asterisk the Fed hikes another 50-75 basis points over 2-3 years, but bond yields remain elevated, supporting your income. 3. Asterisk asterisk the Fed cuts but gently. The Fed cuts by 25-50 basis points. Yields decline modestly, and your income drops by 5-10%. All three assumptions underweight the scenario the futures market is pricing. The Fed cuts by 75-100 basis points in a relatively short window, 12-18 months. Term premiums compress as growth concerns rise, and your bond income declines by 20-40%. Why does the futures market think this is likely? 4 data points. First, the yield curve is inverted. In January 2025, 2-year Treasury yields exceeded 10-year yields, a signal that the market expects near-term rate cuts. Inverted yield curves have preceded every recession in the past 60 years. Second, credit card delinquencies and auto loan defaults have been rising. As of Q3 2024, credit card delinquencies hit 2.9% above pre-pandemic averages. Auto loan delinquencies are at their highest since 2010. This signals consumer stress and a potential trigger for a rate-cutting cycle. Third, real wages adjusted for inflation, have been declining for the bottom 50% of earners since mid-2024. While headline employment numbers remain solid, wage growth is not keeping pace with cost of living. This reduces future consumption and growth. Fourth, the Fed's own sticky inflation measures, which focus on components of inflation that don't easily reverse, have been cooling. Supercore inflation, tracked by the Atlanta Fed, fell from 4.29% in 2022 to 2.8% by January 2025. Powell's ammunition to stay on hold is eroding. What this means for your portfolio. You have 3 options. Option 1, hold and accept lower income. Keep your current allocation, accept that your income will decline by 15-25% if the futures market is right, and adjust your spending downward. This is the safest option, but it requires lifestyle changes. Option 2, extend duration selectively. If you believe the futures market is right and rates are coming down, you can lock in current yields by extending portfolio duration. Buy longer-dated bonds, 7-10-year now at 4.03% yields. As rates fall, you'll capture price appreciation. But this strategy adds interest rate risk and requires conviction about the Fed's path. Option 3, rebalance to equity with caution. Move 10-15% of your bond allocation into diversified equities, not just high-yield stocks, but also companies with growth potential that will benefit from Fed rate cuts. This reduces your current income by 1-2%, but positions you for capital appreciation as the cutting cycle unfolds. The key is to do this gradually, not all at once. The mistake most retirees make is inaction. They assume their current plan is still valid because Powell said rates would be patient. But the market has moved on. By the time Powell officially